I am thrilled to discuss a groundbreaking financial concept that revolutionized the way we understand and value options and derivatives, the Black Scholes model. In the next 10 minutes, I will delve into the origins of the Black Scholes model, its key assumptions, its mathematical formulation, and its profound impact on the field of quantitative finance. The Black Scholes model, developed by economists Fisher Black and Myron Scholes in 1973, is a mathematical framework for pricing options and other financial derivatives. It provided a breakthrough in the understanding of option pricing, previously considered a complex and uncertain task. By introducing a rigorous mathematical formula, the Black Scholes model enabled investors and financial institutions to quantify the value of options and make more informed investment decisions. At its core, the Black Scholes model is based on several key assumptions. Firstly, it assumes that financial markets are efficient and that there are no arbitrage opportunities available. This implies that the price of the underlying asset follows a random and continuous process, typically modeled as geometric Brownian motion. Secondly, the model assumes that there are no transaction costs, no restrictions on short selling, and that it is possible to continuously trade the underlying asset. Lastly, the model assumes that the risk-free interest rate is constant over the life of the option. Based on these assumptions, the Black Scholes model provides a formula to calculate the fair value of a European-style option, which can only be exercised at expiration. The formula takes into account various factors, including the current price of the underlying asset, the strike price of the option, the time remaining until expiration, the volatility of the underlying asset's returns, and the risk-free interest rate. The mathematical formulation of the Black Scholes model involves a partial differential equation known as the Black Scholes equation. This equation describes the evolution of the option price over time and can be solved using various mathematical techniques, such as the technique of solving partial differential equations known as the heat equation. One of the most significant contributions of the Black Scholes model is the concept of delta hedging. Delta refers to the sensitivity of the option price to changes in the price of the underlying asset. By dynamically adjusting the holdings of the underlying asset to maintain a neutral position in delta, investors can minimize the impact of price fluctuations and reduce their exposure to risk. Delta hedging provides a powerful risk management tool and is widely used by traders and financial institutions. The impact of the Black Scholes model on quantitative finance cannot be overstated. It paved the way for the development of sophisticated option pricing models and risk management techniques. The model has been instrumental in enhancing the understanding and utilization of options and derivatives in financial markets, enabling investors to make more informed decisions, hedge their positions effectively, and manage their risk exposure. However, it is important to note that the Black Scholes model has its limitations. The assumptions upon which it is built do not perfectly reflect the complexities of real-world financial markets. For instance, the model assumes that asset prices follow a log-normal distribution, which may not always hold true, especially during extreme market conditions. The model also assumes constant volatility, which is not always the case in practice. Nonetheless, the Black Scholes model remains a fundamental pillar of quantitative finance, and its principles have been extended and refined in subsequent models. Various extensions of the original model have been developed to account for factors such as dividends, transaction costs, and more realistic assumptions about asset price dynamics. In conclusion, the Black Scholes model revolutionized the field of quantitative finance by providing a rigorous framework for valuing options and derivatives. Its mathematical formulation and key assumptions have shaped the way we understand and analyze financial markets. While the model has its limitations, it has paved the way for further advancements in option pricing theory and risk management techniques. The Black Scholes model stands as a testament to the power of mathematical modeling in understanding and navigating the complexities of financial markets.